because I'm a bit in a squeeze standing here, because within the end of the week, I'm one of the startups looking for funding. So when I was looking up to Lucey Fund, I think it was quite interesting saying making startups happen as one of their statements. And they've invested in 140 startups for the past 5 years. And you gave me your conclusions on your election here, that you need more than just money. And there are more startups, but again, there are fewer investments and fewer cases. So I was like, okay, I gotta get my shit together to know that got the right case once I'm looking for investors. And you brought some ideas in the future of investments. I'm looking forward to hearing you.
Brilliant.
Stage is yours.
Hey, thank you for the introduction. I'm Jamie Walsh. I'm the head of finance at the Lucey Fund. And just a bit of background on ourselves. We're very early stage investors. You said we help make startups happen. We've got over 100 investments, largely sector agnostic. It's a global portfolio. It's focused on Europe and the States, but across the world. And something that the investment side of our business is really focused on the last few years, and I think you'll start to see as I go through the slides why, because of the changes in the industry, is acting as advisors to other companies. As the market changes, they need help with people who have experience and expertise. On top of that, we also have a data and cybersecurity software business, Pixalert. So we're operators as well. It's a SaaS business. It's GDPR, corporate scanning data. We're also involved with the Harbour Innovation Campus, which is creating one of the largest co-working spaces in Ireland. And we have a new project that we're very excited about. It's something a bit different for us, but it's transforming a disused golf course into an outdoor sports and activity centre. And what we're looking to do is, to sound a bit cliche, disrupt golf. And it's an industry that hasn't really changed much, and we're looking to take our expertise in technology and software and looking to the future, and a bit of robotics as well, and hoping to make a bit of change there. So I'm just going to start with a bit of a brief outline of our view of venture capital. I think it's great. It provides access to capital, experience, expertise, know-how to people who've been there before, people who've done this, people who've done this for a living. But the first thing I say to people is it's not for everyone. It's often seen as the required route, or historically it has been seen, because that's what we read about in the papers. We read, oh, this company raised this amount of money, and then 18 months later they went out and they raised this amount of money. And so everyone who has an idea thinks that that's the right path for them, and I don't think it is. And one of the reasons as well, on top of all of that, is it's just not friendly to founders a lot of the time. We can just see there, FanDuel, the founders received $0. They had a $465 million exit, but just because of the amounts of money that was raised, and they raised so much at such high valuations, they just couldn't get a return on that. Selling after a Series D round for $210 million or euro there earns founders the same as selling after a seed round at 38 million euro. And then again, Zoox, it was announced 3 or 4 days ago, the founder and CEO was fired without warning just a month after announcing a massive raise from a VC. So as we look to the future of startup investing, we look to the last 12, 24 months trends. So it's important to differentiate. There's early stage, late stage funding. And the late stage, maybe this is a little longer than 24 months, but SoftBank have a $100 billion fund, Sequoia with their $12 billion fund, Andreessen Horowitz have raised $5 billion. There's Chinese unicorns that, they're announced nearly weekly. Recently, Ant Financial, a Chinese financial company, raised at a valuation of $14 billion, which I read somewhere was more valuable than Goldman Sachs. And this is a company no one's ever heard of over here. It's like the masses of money at that end of the market in the States and in China are just extraordinary. And Europe as well, last year, Europe raised the largest round at Atomico, a $765 million fund. So we're not quite at the same level as those guys, but we're definitely, raising these mega rounds. At an early stage, this is where we're more concerned with. And overall, what we're seeing is the overall amounts going into early stage deals are increasing, but the number of deals are decreasing. So more money is going into fewer deals. It makes the deal more competitive. It means if you raise money, that's great, good for you, but it also means it's harder to get into that. And also from an investment point of view, it also makes it more competitive for us. So as a firm, we have to be thinking about, what else can we offer that gets us to the table? Location, traditionally it was seen as the valley. Then there was the birth of the secondary locations, say, as was mentioned earlier, like London, Berlin, Tel Aviv. But in the last 12, 24 months, we've really seen it globalize. There's Cabify in Spain, Nubank in Brazil, raising at unicorn levels. Corporate venture capital as well, that's something that's really having an impact as corporate VCs are really starting to invest more and more. It's their way of outsourcing innovation, I think, and protecting their long-term position. These big corporates have big balance sheets, and in order to protect the future of their company, they're using that power to go in and buy these early phase startups instead of doing R&D in this market. If we look at the auto industry and say the cruise acquisition, that's exactly what I'm talking about here. And the VC industry then as a whole, larger funds are being raised. We need to look at alternatives, and we, as early stage investors, we need to understand the alternatives to help the companies that we have invested in at this early stage as they grow, how they can raise funds. And then we go, what does it mean? We have to be able to adapt and understand these alternatives, and we have to offer more than just money. So for firms, one thing that we have is experience in dealing with growing companies and dealing with them directly rather than acting as a platform. And so one thing that we need to be very sure about is diversity. We have to be aware of the talent war. We have to be good advisors, and we always have to be thinking, what else can the firm offer to our investment companies? So diversity, that's for us, that's as we look around the table, that's diversity of our staff. If there's 5 people with the same 5 backgrounds and the same thoughts and the same way of analyzing things, you're always going to come up with the same answer, and you're always going to make the same mistakes. If you have diversity around that same table, people are going to think about problems and solutions differently, and that's a message that we have to get across to our startups as well. It's not just about us internally. Diversity of talent, again, we have to know people. We have to be able to introduce our companies to the right people. If we have people, we have to be able to introduce them to the right companies as well. And being early stage investors, one thing that's really important for us is the culture and retention of staff, to try and get away from this culture war, or to make the most of it, I should say, the talent war. And we have a great position being at very early stage that we can grow and shape the companies that we're with. So that's something we take very seriously, is your workplace culture, because once it's gone wrong, it's very hard to correct. As I was mentioned earlier, we're also acting as advisors. So having knowledge, expertise, and insight into growing businesses, operating as we are and operating in SaaS. And also we're constantly fundraising ourselves for the other projects as well. And I'll get onto that in a little bit. But being a good advisor, that's something that we think is vital. And these are the things that we expect companies who are raising money in the future to be looking at from all of their potential options. What else can you offer? Will you be able to help us raise more money in 6 months' time or 12 months' time? Do you have the right experience? Do you have the right insight? And some of the alternatives that we've been looking at, and as we see there being less VC importance in the market, there's the rise of these alternatives. Those who raise are raising more than before. Those who don't raise, they need the alternatives. In addition to alternatives providing a lot of advantages that sometimes VCs just don't. And it's our job to understand essentially who our competition is, and also understanding, again, to help our companies go out and raise more money. And the thing that we say to our companies the most is sales. It was mentioned earlier, bootstrapping, how it often doesn't work, and often it doesn't. But if you can get it right, and you can focus on making sales, And that's what we do with Pixela, our software business. We haven't yet raised a round of funding. We haven't needed to. We've been growing very well. And because we've got our product out there to market, our new GDPR product it's going really well for us. But one of the things is we've got our feedback from our customers, and our customers are helping shape that product with us. Private investors, as I was talking about, the Harbour Innovation Campus, our big co-working space, we went and got one big private investor for that. We thought that was the easiest way to go about that. He's now taken on a significant ownership in that business, and we've sort of taken a back seat in a non-exec role. Syndicates, I think, are going to be really important. They haven't really caught on. They've been on the periphery for a while, and it's an experienced investor leading retail investors. Personally, I think they're great because they really expand the potential investor base, and that's one of the positives of some of the, the crowdfunding alternatives that we've been looking at. And I laughed earlier when I saw Nick walk up in a T-shirt that said IPOs are so 2015, and I've got a slide here saying how great IPOs are, and how we're about to take one of our companies through one. So it's an alternative. An IPO is often seen as the exit, sort of when you've reached the end, or when your company's at a sustainable level. But we've actually been looking recently at the Nasdaq First North. Next month I'm going to Stockholm to the Nasdaq office there, and the main positive I think about it is it just builds a better company. You can list with revenues from about 2 to 3 million euro a year, and there's a big retail investment market there, and the market understands that this is a growth platform, that you're raising instead of a Series A, you're not raising and then you're never coming back. So you take an initial hit of where the cost of funding is relatively expensive for that round, but then when you go back to the market in 6 months, a year, 2 years for your next round, it's not unexpected by the market, and it's a hell of a lot cheaper. And again, I just think if you're a public company, you're just building a better company. And as debt as well, it's often seen as taboo for startups, but I think as we move forward and as these alternatives come to the forefront of the industry, perhaps not traditional debt, but peer-to-peer debt is becoming very popular, and I know a couple of our startups have had great experience with it. They find it a lot easier, not necessarily cheaper, but it's a lot easier and a lot quicker. And something that's often overlooked, and you never hear many people talking about it, is invoice financing. And I think that can be great for startups. It's often seen as a bit of a taboo subject to be raising invoice or to be financing your company through invoice financing, where effectively you sell your invoice to a finance house, and then 30 days later, your customer, instead of paying you, pays your finance house because your finance house paid you on the day you received your purchase order. It costs you a little bit of money, but generally it's not that bad. It really helps with your cash flow. It gets you cash in the door the next day if these guys are doing their job right, the financing houses. And it's taboo because people think, oh, that's for a failing company. Well, if you're a startup, most people know you're a startup and that you're customer number 3 or customer number 4, and they've got bigger problems and they know how much you need cash. So I think, sort of just in summary, as a VC, we are very aware of all of these changes. It's becoming more competitive for us. Our startup companies, they need to learn about these alternatives, and I think that's why some of these guys here are going to do a great job and maybe help us out in the future. Thanks.